Hello and welcome to the Weekend Investing Daily Bite of 14th of January, a day which was just stagnant. We jumped up a little bit, small gap, and we stayed there the whole day virtually. This does not signal that we are out of the woods or the trend has changed. It's just a pause day. The good thing, if I were to think about the day, is that we opened gap up and we did not close that gap today. That is the only sign of strength that is there. And there are some other signs that I'll discuss when we discuss the charts. So the main topic of discussion today will be not to get derailed during stock market corrections. We are in a stock market correction. This is not the end of the world. Neither has the correction gone, extreme deep. Yes, some pain pockets are there, but pretty much par for the course actually so far, given the past experiences in the last many decades of such corrections. So the disclaimer is something that you must read carefully. This is for your own good, and you must subscribe to the channel if you haven't. And we are not going to put a paywall on any of our videos. Several of you are asking whether all our content is going to go behind a paywall, like the new trend maybe is there. So no such plans. In fact, our principal approach has been to have all this education always remain available to people who want to learn, people who are already invested with weekend investing, or anybody who'd want to see this. Where is the market headed? So market had a flat day, as you can see in this chart. After this, ferocious down move, we had a flat day. It means nothing. It just is a pause. It could start to waterfall from tomorrow, or we could pause here for a few more days and try to build back up at least above 23,300 to start with, and a 2-day high close if possible. But as of now, don't get your hopes too high about this pause day. 0.39% on Nifty. Nifty Junior was much better, 2.6% gain, but Nifty Junior has also the biggest fall amongst all indices. So there is more of a reaction, more of a dead cat bounce in Nifty Junior. This also, I would not read too much into this. We've lost almost 10,000 points in this flow and recovered, 2 or 3,000 points. So this is very much a natural response to a fall like that. In the mid cap space, again, you had 2% recovery, but then that also is a very natural reaction to this kind of a fall. One would not read too much into that. But yes, a good relief day at best, you can say, for most of the segments. Similarly, for small caps at 1.63%, all remain in a downward mode. Uh, the mode that we started on in the last 7 8 days. Bank Nifty is slightly different chart. We were able to close above yesterday's high. We were able to close the gap above yesterday's high. Uh, this chart is probably the most optimistic charts amongst the ones that I've shown you. And if we are able to build on top of that, let's say tomorrow we are able to close above today's high, that will be the first ray of hope for the bulls here. Bank Nifty usually leads, so banks probably will lead whenever that recovery comes, and we should watch this. So this is, I would say, a decent indication that maybe, just maybe for now, the downtrend has stalled. Momentum trends, 394 advances to 106 declines. Here again, reactionary move. People who are sitting out of the market suddenly, when they see such a big fall, some of that money comes in. Let's buy something, and that kind of gives support to the market, at least for some few hours or few days, and that's what is happening at least as of right now. If more and more such money keeps coming in, then the bears start to retract back. The sellers start to cover their positions. The bulls want more and more, and that's when the auction process starts back up. It takes time. It takes time for that confidence to come. Several pockets again broke down. So IT broke down in a big way. TCS, Infosys, HCL Tech was down almost 9%. Levers was down 3.3%. This is not really good news at all, because levers is very a representation of especially rural demand, um, and that is closing at new lows. FMCG index itself has come to a recent low. We had some good gains in State Bank of India, which is reassuring, but again, this could just be a bounce. HDFC Bank also gaining 0.97%. Reliance has been very quiet. Mahindra, Maruti, Tata Motors, Eicher are gaining. NTPC gained very well. Adani stocks were jumping like crazy. There is some rumor right now that they're doing a lot of fundraising coming forth. So that is the reason. You can just see how Adani stocks were just going all over the place, 13%, 19%, 12%, so on and so forth. Vedanta up 4%, Zomato 3%, Divi's Lab 4.5%, DLF 1.7%, Bajaj Holding, Bank of Baroda, all gaining well. PSU banks, especially Canara Bank, PNB, doing well along with Union Bank. You had some gain in capital goods. So good bounce day, I would say. LTIM, however, lost 4.6%. United Spirits lost 5% even today. Sectoral trends all positive except IT and FMCG, which lost 2.1% and 1.4%. For the last 1 week, everything is in the red. Real estate is deep in red in the last 1 week, 11% gone in the last 1 month, 16% gone on real estate. So real estate, which was the poster boy for last 1 year, has suddenly started to give nerve-wracking moves to its investors. We are up 3% on real estate now for the last 12 months. Energy and private banks are still leading the downfall on a 12-month basis. Pharma is the sort of defensive, safe place where money is going. Pharma is up 28% for the year, 1.4% for the day. PSU banks and metals led the rally at 4% each for the day. PSU banks sharp comeback, closing well above yesterday's high, closing this gap and recovering back from this, the breakdown point. So PSU banks probably have the best recovery path so far. 18% up on IOB, Central Bank 18%, UCO Bank 17%. These are large numbers for a recovery day. So this is a very strong, you can say, bear market, contra move. Whether this will last or not, we will only come to know, but it does look very, very promising from the looks of it. The don't get derailed during stock market correction is the video for the day. So let's go through the mindset of the investor at different stages of the market cycle. So let's take this example from 2011, 12, 13. We had the market go up till almost 2020. We did not have very big corrections on the way. And sort of this became the glide path for the market, that we will go up, we take resistance, we come down, take resistance, go up, take resistance. So this became like the go-to line in that past decade, that every time we are away from that resistance line, we could have gone towards that resistance line, and from there we'll take some correction. What happened in 2020, that market suddenly collapsed, and it was of course the COVID reason. Now the expectation completely changed from here, where you were at an expectation that you'll stick near this line. Now suddenly you are here, and now the expectation is that can we somehow at least get back to this trajectory as soon as possible. So there's the phase two of hope that is there. First one was a sort of expectation. Next is now, we are burnt and bruised. Now the hope is that we can recover. Then the recovery came, and there's relief that a lot of folks probably got out at this point near 12,000, 13,000. That recovery has happened. Now we are back at that channel that we were looking at, and markets have been badgered with the global economy has been badgered with COVID, etc. So how market will go up? Nobody would believe that market could go up well beyond the point from where it dropped at COVID times. So a lot of folks sold off here, waiting for it to again come down as it has been all this while. So relief rally, and then the greed rally started, where at every point people want to buy, and the money kept flowing in, and you tend to sort of believe that this has become now the new norm. Now this channel that you have established here, this is now the new norm, and you've forgotten about the old pace of the market growth, and the greed has basically gone to the next level in terms of, and you've not seen big corrections in the last so many years. So people forget about corrections, people forget that stocks can drop, people forget that this asset class gives you fantastic returns because there is an inherent risk in it. You can't have the cake and eat it too. So if you want returns, you will need to bear the risk and also bear the volatility in the market. So that's when a correction will come in. It will reset the expectations. It will humble all market participants. A lot of excesses will get removed. Stocks that become overowned may become underowned. Stocks that have gone way beyond where they should be, perhaps from a valuation perspective, also come back. Liquidity that has gone into some of these stocks because some stories were made around what kind of returns can be made there, what the promoters will be doing. Also, gradually as liquidity comes off, analyst when the market starts to fall, prices come down, analysts also temper their expectation. Their 12-month targets also start to come down. So most of it, liquidity is determining all these factors in the market. And this has happened many times. So in the 90s also, there was this phase of 92 to 2004-5 where we were going along a you can say a path of the market where we would constantly go up down, and go up a bit each time. But then there was a phase where emerging markets took off in a very big way, and then they were humbled back towards the support. And so basically the chart that you've all seen many times before also is that we will go through euphoria, and then capitulation, denial, fear, panic, capitulation, and maybe discouragement. So I think we are nowhere near discouragement or dismay. Maybe we are somewhere around here. There may be more to come. I don't know whether this is that cycle yet or not. Not every cycle will go through a deep phase of capitulation or discouragement. But as investors, we must keep our expectation in check. If you came in 5 years back, check where you are and what you had expected 5 years back. You probably are much ahead of where you expected where you are. If you came in 3 years back, you're still probably much ahead of where the long term averages are. If you came in last year, yes, there would be some anxiety and some discouragement happening because of that. So going through an entire cycle of maybe 5, 7, 8 years will teach you all the lessons. Then that's where you'll truly be able to possibly detach yourself from market emotions and focus on process and systems. The key is that you should be able to take a step back and see yourself from a third person's perspective, that what is this investor doing, how involved is he in terms of being wedded to the stocks that he has, or how well is he executing the system that he thought he will execute. When he is pressed to the wall, when there is stress in the system, is he deviating, is he trying to take some shortcuts, is he trying to change the plan of action? So if you see yourself from a third person's perspective, you will figure out how far ahead on this journey you are. And of course, if you have educated yourself, if you're learning, you will know, you need to diversify, you need to do asset allocation and all those things that will help you calm down in terms of your approach towards the market. Your expectation from the market should not be more than what you're going to get. That is a sure shot disappointment setting up for you. If your expectation is lower and the market delivers more than that, that is real excitement for you. So if you expect you will get 12 to 15% and you get 20, that is happiness. But if you expect 30 and the market delivers you 15, you will be thoroughly disappointed, even though 15 is a fantastic compounding number. So have the expectations at a real level. For instance, 5-year rolling CAGR on Sensex for the last 30 years or maybe even 40 years has been, in a reasonably good range, except for some time periods. So you would have double digit 5-year rolling CAGR for most parts, high double digits. 99% is the chance that if you are in the market and you're having spent 10 years in the market and of course not doing anything stupid, you are with the rolling returns of 10 double digits again, even periods of high 18, 19, 17, 18, 19%. This is the index I'm talking about. Your strategy should be able to do much better than the index. So the market is a good place to make risk premiums. The expectations should be right. The disappointment about short-term movements of the market should be limited. I will not say that you can achieve a level of sort of mental state where no loss impacts you. Then potentially you are no longer human to that extent. But reduce your emotional quotient in terms of how you look at the markets. Know that it is a long-term journey. Know that these are roadblocks. These are like speed bumps on a long journey. When you go through a long journey and you hit some speed bumps, do you stop the journey? Do you come back home and say, no, I don't want to go on this path? So these are known devils in the journey of achieving what growth we are trying to achieve here. And acceptance of all that is probably the way of enjoying this journey and making sure that you make the best of it. So let me know your thoughts on this. Thank you so much for watching, and do like and share these videos if you do, and do subscribe to the channel and share it with your friends and family. Thank you. Bye bye.